Ready to invest your hard-earned savings, but fear falling into common beginner mistakes? Brace yourself. In this video, we will uncover the 4 greatest pitfalls that could wipe out your complete portfolio and reveal how to stay ahead of the game. Are you ready to make smart investments? Let's get started. The first mistake is one of the ones that gets overlooked the most. Not investing in yourself. Investing in yourself should always be a priority before even start investing your saved money into the stock market. Your personal career development should always come first. It's important to evaluate your current situation and ask yourself if you're happy with your job. If you dread going to work every day, it might be time to make a change and invest in your career. If you have always wanted to start your own business, now is the time to invest in yourself and make that a reality. Prioritize your goals and invest your time and money in yourself to achieve them. But where should you start? Improving your skill set is a great place to begin. Here are 4 essential skills you should focus on to help you succeed in your career. Time management. Practical time management skills can help you become more efficient and productive, reducing stress and increasing success. Good time management helps you get more done in less time. The book Eat That Frog by Brian Tracy is a great resource for time management techniques. Money management and budgeting. Effective money management and budgeting skills can help you reach your financial goals. By reducing expenses and growing profits, you can use your money wisely. Remember, a penny saved is a penny earned. The book The Total Money Makeover by Dave Ramsey is a popular resource for personal finance and budgeting. Negotiation skills. Negotiation is a part of both personal and professional life. This skill can help you get desired results from any situation. Communication skills. Superior conversational skills can set you apart from others and make others feel comfortable when they talk to you. Active listening, non-verbal cues, eye contact, and attention to detail are key components of good communication skills. Reading books on these subjects can help you improve your skills and give you the knowledge you need to succeed. The right mindset is everything, and investing in yourself can pay off in the long run. So take the time to improve yourself and watch as your career and financial success grows. Don't forget to check out the links in the description for the recommended books on these topics. Investing is a great way to grow your wealth over time, but it's important to do it wisely. One common mistake that many people make is investing all their money at once, without any sort of backup plan. Before you start investing, it's important to have a cash reserve you can fall back on in case of unexpected expenses, costs, repair, or job loss. Having a cash reserve can give you peace of mind and help you avoid selling off your investments at less profitable moments. A study conducted by Vanguard in 2020 found that having a cash reserve can help investors stay invested during periods of market volatility, which can lead to better long-term outcomes. Let's take the example of John, who decided to invest all his savings in the stock market without a cash reserve. Unfortunately, a few months after investing, John lost his job and was unable to find a new one immediately. As a result, he was forced to sell his investments at a loss in order to cover his living expenses. If John had built up a cash reserve before investing, he would have avoided selling his investments at a loss and potentially missed out on the market's eventual recovery. If you don't have enough savings to build a full cash reserve, don't worry. You can still start investing on a budget. To minimize risks, it's better to spread your investments over time and across multiple sectors and countries. This is known as diversification and helps to maximize opportunities and minimize risks. A study conducted by Fidelity in 2020 found that dollar cost averaging, which involves investing a fixed amount of money at regular intervals, can help reduce the impact of market volatility in your portfolio. By investing a fixed amount of money over time, you can avoid the risks of investing all your money at once and potentially missing out on better buying opportunities in the future. In conclusion, investing all your money at once without a cash reserve is a risky move. It's important to have a safety net that you can fall back on in case of unexpected expenses or job loss. If you don't have a full cash reserve, consider starting with a diversified investment strategy and dollar cost averaging to minimize risks and maximize opportunities. Remember, investing is a long-term game and it's important to approach it with patience and discipline. Waiting for the perfect moment to invest is a common mistake made by beginner investors. It's understandable to want to wait for the perfect moment to invest, but the truth is that it's very hard to predict the markets, what they will do. Trying to time the market can lead to missed opportunities and lower returns in the long run. A famous example of this is the story of Bob, who invested $10,000 in the S&P 500 index in 1980 and left it untouched for 40 years. Despite numerous market crashes and economic recessions during that time, Bob's investments grew over $300,000 by the end of 2020. This is due to the power of compounding, a concept that is known as the fourth law of Newton. The longer you stay invested in a market, the bigger your gains become. According to a study by JP Morgan, missing out on just a few of the best days in the market can significantly reduce your long-term returns. For example, if you had invested $10,000 in the S&P 500 index on January 1st of 2000, and left it untouched for 20 years, your investment would have grown to $32,000 by the end of 2019. However, if you had missed the 10 best days in the market during that time, your investment would only have grown to $13,000. Investing is a long-term game, and it's important to have a long-term vision in mind. Speculating on short-term volatility and trying to time the market can lead to unnecessary risks and lower returns in the long run. Instead, it's best to invest when you have the means to and stay invested for the long haul. In conclusion, waiting for the perfect moment to invest is a common mistake made by beginner investors. Time in the market beats timing the market. The longer you stay invested, the better your gains become. Don't miss out on great market swings or recoveries by waiting for the perfect moment. Invest when you have the means to and have a long-term vision in mind. Remember, investing is a marathon, not a sprint. Buying specific stocks may seem like a great way to make quick profits, especially when everyone is talking about them. But investing in individual stocks can be risky and lead to big losses if things go wrong. This is because the performance of a single stock is often dependent on a specific company, industry or sector. If any of these factors experience setbacks, it could wipe out your entire investment. To reduce your risk, consider investing in a diversified portfolio of stocks. This means investing in a mix of different companies across various industries and sectors. By spreading your money across multiple stocks, you are less likely to be affected by the performance of a single company or sector. This helps to balance out the risks and the rewards of investing. Moreover, it's crucial to conduct thorough research and due diligence when selecting stocks to invest in. Don't just follow the crowd or invest in the hot stock that everyone is talking about. Take the time to analyze a company's financials, management team, competitive landscape, and growth potential. This will help you make an informed investment decisions and avoid potential pitfalls. A great way to invest in a diversified portfolio of stocks is through index funds or exchange-traded funds. These funds are designed to track the performance of an entire stock market index, such as the S&P 500 or the Nasdaq. This means you can invest in a broad range of stocks with just one investment, reducing your risk and increasing your chances of long-term success. For example, a study conducted by Fidelity found that investors who put their money in index funds outperformed those who invested in individual stocks over a 10-year period. By diversifying your portfolio and doing your own research, you can make smart investment decisions and achieve your financial goals. So to recap, these are the 4 most common beginner mistakes that investors make and how they regret avoiding them. Investing in yourself, having a cash reserve, diversifying your portfolio, and avoiding timing the market are key to staying in the green. But the most important thing is to have a long-term vision and always educate yourself on the market and investment strategies. So don't stop here, keep learning and growing as an investor. I will end with a question. What mistake did you make if you already started investing? What did you regret the most when you started investing? Drop it in the comments below and I can't hear from you.